And with me to discuss the latest in terms of the outlook for U.S. shale oil and gas, and also to discuss the developments we've seen in that sector in the first half of 2024. Joining me from Oslo, Norway, is Alexandre Ramos-Peon, the head of Shale Well Research at Rystad Energy. Alexandre, thank you, and it's nice to have you again on the show. Let us begin with the U.S. oil production growth last year, which increased massively with a growth of about 1 million barrels per day. This also coupled with a dramatic improvement in shale operations, despite a pullback in the rig activity and the rig count. What are the factors that have contributed to this production growth last year, and how?
Well, first of all, thank you for the opportunity to be back on your show. It's a pleasure. I would say this really came as a surprise to a lot of market participants, right? That production grew so much while rig count was decreasing. And I think the reason for that is that a lot of people still associate rig activity with production. So that used to be the case many years ago, and it might be in areas with conventional production, but in US shale, the dynamics are a little bit more subtle. And there's three reasons for that. One is that it takes 6 or 7 months between rig presence to first oil, and then a few more months until each of these wells reach peak oil. So if you see rig counts declining now, this will have an effect 6 or 9 months down the road. So in a sense, the rig count declines that we saw last year will impact production in 2024, not 23. The second reason is that operators have also chosen to complete wells or frack wells that had been drilled many years ago. This is known as the DUC inventory, and this is a common point of discussion here in the US. And the third reason, which we will come back to in a minute if I will be allowed, is that the productivity of the wells, it has been speculated, or there's been a lot of noise in the media that this has been declining. So I would call that a misconception. Productivity has not been declining, and when people realized that, then they were surprised that actually production came in so high. But in a sense, the participants in the market were surprised that there was no underperformance, and that had been baked into some of the forecasts.
Alexandre, just a small question here. When we talk about productivity, how are we measuring it? Is it oil production per feet drilled in the ground? What's your measurement?
It's oil production, say, over the first 6 months or 12 months, it doesn't matter, per well.
Okay.
So when I say that productivity has remained stable, it is on a per well basis. The wells have gotten longer.
Yes.
So in a sense, that's the degradation in productivity. You're spending more money and you're drilling longer and you're getting the same amount of oil on the ground. So I will concede that.
Yeah, okay. We'll come back to this topic, I think, more as those lateral wells are growing to 3 miles and even 4 miles. But let's discuss costs. The shale well costs, the development costs are set to be up by 30% higher than it was in the 2020-21 period. Do you acknowledge this increase in the development costs, and what is underpinning those increases, Alexandre? How do you see the costs also evolving lately, and where are they headed?
So first of all, it's true. We acknowledge this cost increase. Operators are paying far more today than just a few years ago for their wells. This has been driven mainly by general inflation following post-COVID global supply chain disruptions. So materials such as steel used for the tubing and casing, or sand used for the fracking process, even diesel for the fracking process, all of these things went up following the global supply chain disruption after the pandemic. That was kind of early on, 2020, early 21, up to second half of 21. Then we're seeing also service pricing escalation, the cost to rent rigs, the cost to frack the wells. And I just mentioned that the performance of these wells had not materially degraded, but you're spending 30% more. So from a capital efficiency perspective, how much oil you get out of the ground for dollar invested, then definitely things are not as good as they used to be. But if you look at the other side of the coin, for the service companies that provide drilling and fracking services, this has been fantastic because they have maintained the supply for their services very tight. So they have increased the cost of the rigs and of their fracking crews, which is a large contributor to the escalation in prices you just mentioned. So these companies are still in control of certain portions of this market, and they have been successful at keeping those prices high by reducing the supply of rigs and fracking crews. So we're expecting that the total cost to drill a well has peaked in 2023. Operators were expecting to see deflation in 24. We don't see that. We think it will still grow a little bit, maybe 3-5% this year. But from 2025 and onwards, we expect a mild deflation, mostly driven by decreases in the service costs. So cheaper to drill, cheaper to frack. So really on the services side rather than on the material side.
And Alexandre, maybe give us or shine a little bit light on the break-even price for shale oil producers right now in the United States, and maybe just put it in the historical context of how this price has fluctuated or changed in the past few years.
Right, that's a good question. So just for context, the break-even price is the price of oil you would need to not lose money on an investment of this kind. If you think historically, maybe 10 years ago, those prices were very high. They were above $100, which is why famously shale was unprofitable. Technology improved a lot, productivity improved a lot, costs went down. And the best period for US shale in terms of commerciality was around 2020, 2021, where the break-even prices averaged $40 to $45. So that's the price of oil you would have needed to make 10% returns on your investments. Costs went up. The intensity of completions went up by about 30%. Productivity did not increase. So that means that today the break-even price is closer to $60 on average in the Permian. So 58. And in some other areas, it's 70, it's 75. And I think that also explains why you're not seeing that much activity anymore, because these activities is just no longer commercial unless you're in the best areas of the Permian.
Let's discuss a hot topic in the shale sector, which is the M&A frenzy. In a latest Fed Dallas survey, more than 50% of the executives told the Dallas Fed they foresee lower domestic crude output if the consolidation trend continues for 5 years, according to second quarter survey results released just a few days ago. Does the frenzied M&A activity, Alexandre, in the U.S. shale sector make it less likely the U.S. will surprise the oil market like it did with last year's unexpected million-barrel increase in daily output, do you think?
I think that's the case, yes. And this is really one of the main points of discussion in the United States right now when it comes to shale. This M&A activity, meaning acquisitions and mergers of producing assets or fresh acreage, has never been as high as we've seen now in the last 6 or 9 months. So in a sense, this is defining a new era of US shale activity and of the market dynamics that we see there. So maybe we can talk about this in a minute, but to answer your question, I do think it's likely we see less surprises. The main reason for that being that with this consolidation in the control of assets being held in fewer hands, we see less elasticity of supply. And we also see that the controlling companies have more transparent and longer term plans. So it's less likely to see, say, a company like ExxonMobil or Chevron suddenly shift 180 degrees from their plans. Whereas, recently, when you had more companies that were smaller, family owned, they could do, the unexpected, and that led to a large number of surprises. Now, you mentioned that the Dallas Fed said that they're expecting, or that the participants expect lower supply. We don't really. We still expect production to grow a little bit, but far less fast than in.
So let me quiz you on this. What are Rystad's estimates for the current U.S. shale oil production and its expectations for 2024 and 2025?
Right. So total U.S. production now is about 13.3 million barrels a day. And, you just mentioned that there's expectations that this is dropping or not growing as fast. However, the current U.S. production is at the historical maximum. So this is despite all of the conversations about deceleration of activity or degradation of productivity. So we still expect growth to continue, but it's going to be much more moderate. If we're at 13.3 now, we might end 2024 at 13.4. So maybe 150,000 barrels a day more than today. Then in 2025, probably we might exit that year at 14 million barrels a day. So that means that you mentioned it earlier. In 2023, we saw growth of 1 million barrels a day. In 24 on average, and in 25, it's going to be closer to 300, maybe 350,000 barrels a day. And that's total US, right? So shale is growing, maybe by a little bit more than that. And then you have declines on the legacy assets. Yeah. So shale alone is about 9.5 million barrels a day. And we expect that to reach 10 million barrels a day early next year, early 2025. So definitely lower pace of growth, but still some growth.
But Alexander, over an extended medium-term outlook, is there a plateau on the horizon for U.S. shale oil production, you think?
There is. So this growth cannot continue forever. We expect that by 2028 or 29, at the end of the decade, we should reach a plateau. Not necessarily a production drop immediately, but a stabilization of U.S. shale at around 10 to maybe 11 million barrels a day.
From 9.5 million today.
Correct. So from 9.5 to, on average, say 10.5, so about 1 million barrels more today in a few years. One key reason for this is the consolidation, right? So the industry is more mature, as we mentioned a minute ago. There is fewer locations. There is more focus on the long term, which means people are drilling more moderately. Then the higher costs we discussed a minute ago means that it's unlikely that you see small private companies drill outside of the core because it's becoming commercial. So we will still see moderate activity to keep that production flat. You will still need a few hundred rigs. And the cash flow that this will generate for the companies that remain active in the long term will still be quite significant. So we're changing the mindset from growth to stability and from increased market share to cash flow generation, which has been also at historical heights.
When would you say the merger and acquisition frenzy will begin to subside? We've seen almost $250 billion worth of M&A deals in the past, I don't know, a year or a year and a half. And do you think it would morph into efficiency-focused land trades between companies later on that would allow companies to, develop these 3 to 4 mile lateral wells instead of right-out acquisitions and mergers?
That's a good question. Our opinion here is that we have probably passed the peak in terms of mergers and acquisitions activity, but we still expect to see a few more deals throughout this year and maybe the next couple of years. There is just far less obvious acquisition targets today, but it is the expectation that this will continue. So if you just think about how consolidated the industry is today versus 12 months ago, it is enormous. So you mentioned $200 billion in asset trades, but if you think about what this means on the land for the geometry of the acreage, it is far more consolidated. So you have about a third of the reserves of shale now on the control of the major companies, Exxon, Chevron, etc. A couple of years ago, it was 15%. So a third of the acreage is now under control of the major companies. Now, the obvious advantage to this for these companies that hold the acreage is that they can drill 3 mile laterals, which is the typical lateral length of a modern shale well now, without having to deal with the constraints of the geometry of their acreage. So if you think, you might have seen these pictures with the Permian Basin, which looks like a checkerboard, black and white pieces, and then operators are unable to drill past the lease line versus their competitors. But now that these things have been merged, then there is no limitation physically, well, at least legally speaking. Now, 3-mile lateral there's about a quarter of the wells now that are 3-mile laterals. We think that will be the new standard. It seems to be the optimal for many companies. 4-mile and above is quite uncommon in the oil basin. So that's common in the gas basins, but I don't think we will see more than a handful of experiments really in the long lateral length range.
Let's focus on another theme. A recent report at Rystad has highlighted the shifting concerns from productivity and costs to long-term inventory. Would you kindly elaborate on that, Alexandre?
Correct. Yes. So we talked about productivity a second ago, and then the long-term inventory, I just hinted to that, right? So activity has decreased, and I think the main reason for that, which is the long-term inventory, is that the majors that control the remaining resources, they're concerned about where they will be, say, 10 years from now, 20 years from now. So the companies that have spent billions of dollars now acquiring land, they don't intend to sell this in the short term. They intend to develop it moderately or responsibly, so to speak, over the next few decades. So that is a question in most investor minds or supply analysts is, if you want to be drilling a significant amount of wells 20 years from now, then you have to be very careful of where you're drilling and at which speed if you want your companies to still be relevant in the supply panorama, say 15 years from now. And this has been really, I think, a focus point. So a couple of years ago, people were concerned about how do you grow fast? How do you produce more from this piece of land? And now it's how do you make this piece of land be profitable 20 years from now, which is what the investors are interested about. And this is really ties back to the acquisitions, right? So when you have a private equity company that is interested in making fast money, they will produce very fast, show the productivity of their land, exit and make money, and then they're out. They don't care. After these acquisitions, these companies are here for the long term, and therefore they care about the long-term inventory.
Okay, let's move now to the shale gas sector. U.S. Natural gas prices fell back in March to the lowest in almost 3 decades, close to a $1.5 per million BTU. This has in turn pushed many to curtail production, forcibly or willingly. Prices have recovered somewhat since then, moving now between $2.50 to $3 last month in June. As such, when do you foresee a recovery in natural gas production levels moving forward, and how do you see that playing out with the direction in Henry Hub gas prices?
Yeah, that's a very good question, and these were indeed very unusual market circumstances. So just for context, at $1.5 per million BTU, very, very little activity in the United States is commercial. So you typically need $2.5, $3.5 per million BTU to break even on the gas side. We didn't mention this, but on the oil side, we talked about the cost escalation, right? So back 3 years ago, at $40, $45, a lot of operations were commercial. Today, it's closer to $65. So that's quite significant. And on the gas side, we're seeing something different. At 1.5, nobody's making money unless you have hedge books or hedged production. Now, if you look just beyond, and that was very short term, right, due to exceptional weather conditions and storage draws. But we think that the growth trajectory of gas will recover very soon. It's very seasonal. The forward curve for Henry Hub is at, I think, around $3 or maybe a little bit more. So as weather stabilizes and the demand for fresh gas increases, as the storage draws come to an end, so essentially by winter, we expect production to be back up to what it was. And we also have a new pipeline that entered into service a week ago in northeastern United States, the Mountain Valley Pipeline, that's going to provide additional takeaway capacity, so there will be more production. There will be a gas pipeline coming on service to extract gas from the Permian to the Gulf Coast that's going to add takeaway capacity. So there's a lot of reasons to believe that gas production will return to its historical heights and keep growing in the short term. because we believe that the short-term Henry Hub prices will be supportive of that activity above $3.
And over the longer term, could U.S. shale gas producers continue increasing production given the growing demand from American LNG, or would the expected domestic price environment be unfavorable, you think?
That's also a very interesting question. We mentioned a minute ago that on the oil side, we expect production to decelerate. On the gas side, the picture is quite different. We think that there is a case to be made for very strong demand for gas in the longer term. There will be liquefied natural gas facilities, LNG coming online in the next few years on the Gulf Coast. There will be increased domestic gas demand for data centers, right, around all of this AI revolution that is happening. So if if we look at the short term, the gas prices look unfavorable, but there's good reasons to believe that gas prices will increase significantly in the longer term because of the demand. So I think that there is also good reasons to believe that gas production will keep accelerating actually over the next decade. And the amount of locations where you can produce gas very cheaply in the United States is just mind-blowing, as opposed to oil, which is a little bit more limited.